Every month that passes without a decision is a choice. You allocate your wealth to cash by default whenever you leave money untouched. Behavioral economists call this the default effect. In personal finance, the default is a low-interest account. Doing nothing selects an asset class with a specific, calculable, and poor long-term return profile. Over the next 6 minutes, we are going to calculate the precise cost of that delay. Then we are going to fix it together, in real time. To follow along, you will need 15 minutes, a government ID, your bank login, and an initial deposit of $10 to $50 ready to transfer. Recognizing that inaction is a costly, active choice is the necessary first step. Once you see the actual number attached to doing nothing, breaking the cycle of procrastination becomes a matter of basic logic. Let's make the opportunity cost concrete. Imagine a person setting aside $300 a month over a 20-year period. This chart shows the default outcome. If that $300 a month sits in a savings account earning a 1% yield, the total contributed over 2 decades is $72,000. It grows to roughly $79,500. Compare that to the investment path. If that same $300 a month goes into an index fund at a historical average annual return of 7%, that $72,000 contribution turns into $147,000. The difference is $67,500. Same person, same monthly effort. That gap is the literal price tag of inaction. Most people experience procrastination as one more year, repeated, but even a short delay has an aggregate cost. This graph tracks the growth of investing $400 a month until retirement at age 65. If you start at age 25, you finish with over $1 million. Waiting until age 26 to start investing the exact same monthly amount reduces that final total by roughly $75,000. The cost of delay is not linear, it accelerates. Delaying at age 25 is more expensive than delaying later because you sacrifice the longest tail of growth. The year you are most likely to dismiss is the one that costs the most in your final years. If the cost is that large, why do so many stay stuck? Usually it is complexity paralysis, the fear of picking the wrong fund, the wrong platform, or the wrong time to start. Historical market data helps put this fear in perspective by comparing investors with poor timing against those holding cash. This chart compares the two strategies. The top line represents an investor who bought at the absolute peak of the market every single year for 20 years. The bottom line is an investor who kept their money in cash. Even with the worst possible timing, the investor who entered the market outperformed the one who waited. Waiting until you can time your entry perfectly is a trap. It keeps your money in the lowest performing asset class, cash. Imperfect action beats perfect inaction every single time the numbers are tested. Let's fix this right now. Pause this video, open a new tab, and begin creating your investment account. Choose a reputable brokerage in your country and select a basic, low-cost global index fund. The platform does not have to be perfect. It just needs to be functional. Fill out your details, link your bank account, and initiate your first transfer. Transfer an amount that feels almost too small to matter, $10, $20, or $50. The goal is to force the mechanism to work. The dollar amount is irrelevant today. An account with $10 in it can grow. An account that has never been opened cannot. Now that the account is active, navigate to your settings and find the recurring transfer option. Set up a small, automated monthly deposit. Schedule it for right after your paycheck arrives, so the process happens in the background. Automating this removes willpower from the equation and protects you from falling back into the habit of delay. If you followed those steps, you are officially an active investor. You have traded an indefinite delay for an automated start. Be honest in the comments. How long did you mean to start before taking action today? Naming the gap is the first step toward closing it for good. Share this video with someone stuck in analysis paralysis. Closing the gap between intention and action is the only way to transform the math we calculated today into your own financial reality.